Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. U.S. President Donald Trump says strikes against Iranian energy infrastructure and power plants would be postponed for 5 days following the start of talks with Iran to end the war. Trump also says the halt to attacks are subject to the success of the meetings and discussions. Trump had initially given Iran until this evening to reopen the Strait of Hormuz, or the U.S. and Israel would start bombing the country's power plants. The head of the International Energy Agency is warning that the global economy faces a major threat because of the Iran war. Fateh Birol says the situation is very severe and no country will be immune to the effects if the war continues. He says the crisis in the Middle East has had a worse impact on oil than the two oil shocks of the 1970s combined, and a worse effect on gas than the Russia-Ukraine war. Two Air Canada pilots are dead after an Air Canada Express plane collided with a fire truck shortly after landing at New York's LaGuardia airport. Pilots died on impact. There were 72 people aboard. 41 were taken to hospital. Many of them are now in serious condition. Air Canada says it is cooperating with the Transportation Safety Board of Canada and the National Transportation Safety Board in the U.S. as they investigate. And to the markets now. Look at the reaction we're getting on what Donald Trump, the U.S. president, had to say earlier about these talks with Iran happening and a pause in any bombing or escalation of bombing. They are happy to see this. The TSX up 2.25%, and south of the border, it's a similar situation. The Dow, NASDAQ, S&P 500, all of them up more than 2%, Dow by 2.4%, and NASDAQ about the same. All right, oil is falling. Stocks are rising after the U.S. president announced he's postponing strikes on Iranian energy infrastructure. However, Trump also cautioned that the delay of attacks is dependent upon the success of ongoing meetings and discussions. Here to tell us what that means for Canada is Jay Bala, CEO and Senior Portfolio Manager at AIP Asset Management. Jay, thanks very much for joining us.
Hey, no problem. Thanks for having me on.
The markets are happy for today with what we're seeing. Where does this leave us right now?
Sure. I mean, look, overall, I think you're seeing a relief rally. So I think a lot of people are back on, on sort of the idea that it's a risk-on environment again. In particular, we've always stated this, and, the reality is the world's problems in many ways are not Canadian problems, right? And so, compared to even the last oil shock we had in the 70s, Canada and in particular North America is in a very, very different place in terms of energy and in terms of energy infrastructure. As a continent, we are now energy independent. We do not need the world's oil or gas or anything else. I mean, between Canada and the U.S., we're perfectly self-sufficient. And so I think, people need to understand that as a reality, right? And so, you've got the short-term rally, but I think, investors should also look at sort of the longer-term impacts of that, which is, there is value to having stability. And so, for everybody that said maybe that Canadian oil was dirtier or maybe a bit more expensive or our assets were a bit more expensive, the reality is it's premium priced because Canada gives you stability, right? It gives you that safety cushion. And so, if Canada ships a tanker full of LNG, that tanker is going to get to its destination without, anyone worrying that, a missile's going to hit it, that there's some kind of attack on it. It's going to land. It's going to be just-in-time inventory. It's going to give you exactly what you need when you need it. And so there's value to that, right?
But do you think there's enough impetus right now to make it attractive for people with those, what you mentioned about maybe being dirtier than most and also the value on it?
Yeah, no, absolutely. I mean, I think, this crisis has cemented that proof because, this is the start of maybe probably longer-term chaos in the Middle East, right? I mean, it's not like you can just go attack a country and then leave and then expect that nothing will happen in the next 5 to 10 years. I mean, obviously, irrespective of how the war in Iran ends, I mean, I think Iran's going to be a bit more defensive, right? They're going to, spend a lot of money on their defensive capabilities and worrying about keeping the regime alive. And so that's not going to be, a catalyst for stability in the region, right? If anything, it's additional chaos. And so if you're looking at markets, particularly in Asia, like Japan and Korea, that were particularly impacted by the oil crisis, I think they're going to look to diversify their energy resources.
And is there any other country in a similar situation as Canada with this opportunity, but maybe better set up with infrastructure? I mean, because that's always been Canada's shortcoming, is how do we get what we have to where it needs to go?
Yeah, I mean, it's interesting. I mean, in terms of energy reserves, I mean, the other competitors would be Russia or Venezuela. But the reality is, I mean, they're politically unstable, right? I mean, at the end of the day, Russia's got political issues and a war going on in Ukraine, which has caused significant problems. And then in Venezuela, I mean, you've had political change there, and we don't know how stable that's going to be and how realistic that is going to be. So I think, it is in the world's best interests to maybe encourage the Canadian government to actually build out that infrastructure and provide that stability, right?
And now looking at, we're seeing oil down, it's almost down 10%, I think, right now. The markets are up. How do you see this impacting inflation, the rates, and the markets longer term rather than just this reaction today?
Sure, it's a good question. In terms of oil, it's obviously going to hit the top line inflation number. It'll make it a bit more difficult for central banks to cut rates. But the one thing that people have to remember is, over the longer term, central banks are going to look at core inflation, not headline inflation. And so for core inflation, oil is simply not factored in. And so it's not going to have the same impact that people think it's going to have, right? I mean, at the end of the day, it's going to hit the consumer's bottom line, but it's not going to change central bank policy all that much.
And so what do you see for rates? Where do you see rates going then?
I think rates will stay, relatively flat for the next few quarters, just so that, the central bank can sort of figure out where the economy lands in all of this.
And then within the markets, with everything that's going on, where are you looking? Where are you avoiding?
I mean, where we're looking at is anything effectively that's event-driven. We think this is an event-driven market, and event-driven strategies will do incredibly well in these kinds of environments. So, we're looking at convertible debt, we're looking at alternative income, and we're looking at energy in particular. Areas that we've decided to avoid is just really real estate, and that's just given all of the gating that has happened in all of these private real estate funds recently that's given us some pause.
And with the alternative income convertible debt, what are you liking about that? What makes it attractive right now?
With convertible debt in particular, you're still getting some reasonable downside protection on it. You're getting paid to wait because you're getting a bit of a yield. But in times like this where you've got a sharp rally in the equity markets, you still get to participate in some of that equity upside.
And with the energy side, I mean, it's up right now, but is it beyond that is attracting you?
Yeah, I mean, I think, like I said, I think longer term, I think there's going to have to be a policy shift in Canada to say, hey, look, we need to become more valuable to our allies and to ourselves. And so, the reality is that the Canadian government is going to really push here to create that stability, to build out that infrastructure, to basically at least create these strategic energy reserves so that we can be a value add to, both ourselves and our partners, right?
All right, and just one stock, you've got Dollarama on here. What's drawing your attention to it?
Yeah, no, I mean, I think the reality is, look, we don't look at particular stocks in general. We just look at general, like I said, event-driven strategies. So I think for Dollarama, it was just that, if this was a prolonged war in Iran, then, obviously people would kind of gravitate to these kinds of stocks.
All right, well, we'll leave it there. Jay, thanks as always for joining us.
No problem. Thanks so much.
Jay Bala, CEO and Senior Portfolio Manager at AIP Asset Management. Up next, oil prices dipping 10%, 11% right now. We'll find out why with our next guest. That's after this. Oil prices drip. Well, they do drip. They dripped dramatically today after U.S. President Donald Trump signaled a pause on further action against Iran, stating productive talks with Iran, but Iranian media denying any of those talks are going on. Here to discuss how this back and forth may impact oil is Stuart Glickman, Director of Equity Research at CFRA. Definitely not dripping today. They're dropping quite a bit. Stuart, thanks very much for joining us. How are you approaching what we're hearing today?
Hi, Roger. Thanks for having me. So I think it's probably more productive to think about the interruption of the product flows rather than the statements that are being issued, because the statements have changed multiple times over the last couple of weeks. But the industry is not set up for handling this level of interruption of normal oil flows. The Strait of Hormuz accounts for about 20% of global oil supply. It is far in excess of any other spare capacity that the world has lying around. So the fact that oil prices rose to, call it roughly $100 a barrel, seems, honestly, I think it's an underreaction to how tight the markets really are. I know that they're down about 9% today. I think in hopes that the worst may be over, but I don't think it's time to call off this latest set of hostilities.
And is this going to be one of those we have to wait for literally for the smoke to clear to see what kind of damage there is and how they're going to try repair and play catch up?
Yeah, so I think there's two ways to think about this. Number one is it safe for tankers to make their way through the Strait of Hormuz or not? War insurance premiums, which normally would cost the shippers somewhere between 0.25% or maybe 0.5%, have risen, to, I've heard as much as 5% of cargo value, which is an awful lot. It's really a prohibitive level for a lot of shippers. So most insurers are telling their tankers, just stay put. And so there's virtually nothing that's making its way through the Strait of Hormuz at the moment. If that gets lifted, if that situation changes, that would be a plus. That would put downward pressure on oil prices. The second one has probably more long-lasting effects, which is if there's actual physical damage to oil or natural gas installations in the Gulf, that's going to take time to repair, no matter what happens on the political level. So, for example, Qatar is one of the three big providers of liquefied natural gas, or LNG, to global markets, and some of their installations have been knocked out for a considerable length of time, probably somewhere between 3 and 5 years. So that's helpful for other major natural gas producers of LNG, like the U.S. and Australia. But even if the hostilities end tomorrow, that's not going to help Qatar. It's not going to help global markets when it comes to LNG.
I just want to ask out of curiosity, the insurance companies, so 5% of the value of the oil, what would that represent? Like, how much is a tanker of oil worth going through there?
Right. So, great question. So the tanker itself of one of these very large crude carriers carries, has a hull value of, let's say, $250 to $300 million. It can hold 2 million barrels of oil. Let's say it's trading at $90 a barrel. So that's another $180 million. So one trip through the Strait of Hormuz to insure that cargo and haul is about, well, let's call it $450 million, round number. 5% of that is going to be somewhere in the neighborhood of $22.5 million for one trip. It takes about 3 weeks to get from the Persian Gulf to, let's say, a port in China, and you're going to have to pay that over and over and over again unless you get sort of a calming down of the hostilities.
And with the backup that's been building through the Strait, I mean, some of the Iranian oil is getting through, but most of the others, nothing is getting through except for that one Greek guy apparently is running magic. How do you get rid of that backup, or is it like how do you catch up when you only have X amount of ships?
Yeah, you really can't. So you have producers that can't get their stuff above ground because they have no place to put it because storage is full. You have markets in Asia that are starved for crude oil. We're approaching. We're past the 3 week mark since the beginning of this fighting. So there are ports in Asia that would normally be expecting cargoes to arrive with more crude that aren't getting it. So I do think that there's a considerable amount of tightness in the market, and I think the move down today is sort of hope as a strategy, and I would not want to bank on that.
And now you mentioned about the U.S. and Australia natural gas producers, possibility of picking up the slack for that. Could Canada, is that a space for Canada at all? Would we be able to ramp up before those repairs were made in Qatar?
It's a good question. So LNG Canada is in the midst of ramping up. Cedar LNG is also in the midst of ramping up. So it's a question of number one, how quickly can they get going to full capacity, and number two, how much of their capacity is not already contracted on a long-term basis. Most LNG providers, when they agree to get going and break ground on construction, they certainly require, I would say probably 2/3, 70%, somewhere in there, of long-term contracts already signed in order to break ground, because these are very expensive propositions. Mm-hmm. But there is some spot market exposure, right? So whether they can ramp up quickly to take advantage or not, unclear at this point. But I think longer term, Canada offers something that the Middle East right now can't, which is reliability of supply. So once you get going on a commercial level and can prove that your cargoes are shipping out on a regular basis, on time, I think that lends itself to more customers saying we'd rather hitch our wagon to Canadian LNG. It's a relatively short distance from the west coast of British Columbia to Asia, certainly a lot faster than it would be to go from the U.S. Gulf, because then you have to go through the Panama Canal as well.
Okay, we have to wrap it up there, but Stuart, thanks very much for joining us.
Thank you.
Stuart Glickman is Director of Equity Research at CFRA. Coming up, today's market drivers with Bloomberg's Monique Molina. Time now to take a look at today's market movers, and we're joined by Bloomberg Equities reporter Monique Molina. And Monique, thanks as always for joining us. First up, TeraWulf got rated a new buy, and what's going on with it?
Hi, yes. So TeraWulf, they were initiated by Arete Research, and their shares are rising higher. The company is a Bitcoin miner, but it also has now shifted into data center operations, and that's really where analysts see the upside going forward. They say the company right now is attractively valued, and they think as the data center power continues to expand, that it's going to be an even more attractive stock for investors. They also note that with the declining Bitcoin prices and some of the economics around Bitcoin mining, they expect that by the end of the year, TeraWulf will completely stop their Bitcoin mining operations so that they can just focus on data center operations, which will also allow them to convert some of their existing mining facilities for power for things like artificial intelligence or other compute, which is an area that's seen a lot more growth. All
right. And next up, is it PG&E or PCG? I might have the wrong PCG.
PG&E and the
so ticker is PCG.
Ticker, yes.
And I thought it was exactly. I thought it was Procter and Gamble when I was looking it up. I'm like, no, it's an energy company down south.
Yes, so PG&E, they are a utilities company in the U.S. A lot of their operations are in California, and their shares have been rising recently as the California government was looking to reform some of the wildfire liability policies in the state. But analysts at Jefferies downgraded the stock today, saying that after they have talked with stakeholders in California, they think these wildfire reforms are unlikely to happen this year. The hope had been that the reforms would take away some of that liability that's currently on utilities companies in the event of wildfires. But as conversations have been happening, analysts say the insurance companies, the California government, and the utilities companies have not all been able to come to an agreement as of yet. So they think that this is unlikely to result in what some of these utility companies had been hoping for. And they note that PG&E has an especially high risk exposure to wildfires in California. So this had been something that would have been really positive for the company.
All right, and last up, in the wake of that horrific incident at LaGuardia with that Air Canada flight that killed the 2 pilots, more rough news for U.S. airlines?
So definitely that was really rough news for the U.S. airlines. It's a really unfortunate situation that we saw with Air Canada, but we're actually seeing the shares not react as negatively right now. The airlines were down earlier this morning in pre-market trading, but we saw that reverse after President Donald Trump announced that the U.S. would be doing a 5-day ceasefire on Iranian energy assets. And as a result of this, we saw oil prices fall about 10% this morning. And that boded well for the airlines, which are now seeing their stocks higher because a large part of their costs are fuel costs. So when energy is more expensive, that's going to compress their margins, versus now with energy expected to be a little lower, that could help their margins, and the hopes that maybe this ceasefire could lead towards an end of the conflict. And if that happens, that will also open back up some of these airline routes that have been constrained ever since the start of the war.
All right, the markets are like the weather right now. Give it 5 minutes and it will change. Monique, thanks very much for that.
Thanks.
Bloomberg's Monique Malima. When we come back, the themes investors are leaning into as markets try to find their footing. The head of the International Energy Agency is warning that the global economy is facing a major threat because of the war in Iran. Fateh Birol says the situation is very severe and no country will be immune to the effects if the war continues. He says the crisis in the Middle East has had a worse impact on oil than the 2 oil shocks of the 1970s combined. It's also had more of an effect on gas than the Russia-Ukraine war. Shares of Transcontinental are down right now. After its shares started trading at a new level, the move follows the company's special cash distribution tied to the sale of its packaging business earlier this month. Transcontinental's board authorized a special cash distribution of $20 per share after agreeing to sell its packaging division to U.S.-based Pro Ampac Holdings for $2.1 billion. It's down 70% right now. Shares of Sony are trading higher after a report from Bloomberg that the entertainment giant is nearing a roughly $1 billion U.S. deal to sell a majority stake in its home entertainment unit to TCL Electronics. The transaction would build on a previously announced joint venture that would see TCL take a 51% stake and oversee production of televisions under Sony's Bravia brand. And looking at the markets, that pent-up demand unleashed on the president's comments about Iran and that they were in talks and there was a bit of a ceasefire for the next 5 days. The TSX up more than 2% and south of the border, not much different. Everything in the green right now, all hovering around those same marks. The S&P 500 up by 2%, Dow 2.25%, NASDAQ the same. Now, the markets are starting the week in the green after that pullback last week. Now, they also started last week in the green. The geopolitical tensions, rising oil prices all weighing on sentiment then. Volatility, though, still the word of the day. Investors rethinking where to find opportunity and how to manage risk. Our next guest will break down the themes he's watching in the current market. Joining us now, Matt Miskin, co-chief investment strategist at Manulife, John Hancock. And Matt, thanks very much for joining us.
Thanks for having me.
All right. Last week started up for 2 days in a row. This week, though, is there more optimism for what we're seeing today?
Yeah, we are seeing oil prices reverse course and fall on the headlines this morning. To us, we're really trying not to invest based on geopolitical headlines. This is a very fluid situation. It could change on a dime. We're really focused on where we're finding better fundamentals. And frankly, that is in infrastructure-related equities. So utility-type businesses are strong earnings growth. They're more insulated in the economy. They have a good dividend yield and lower beta. Other things we're using right now, long short equities, so things that can protect and provide a tail hedge with some short exposure on pockets of the market that are overvalued, and then a multi-alternative strategy. So finding diversification with things that are not reliant on stocks going up and down really fast, but looking for strategies that can lower risk in portfolios and help navigate this challenging macro environment.
I'm just curious with everything that's gone on, where are you finding those pockets that are overvalued?
Yeah, I mean, it comes back to where we were actually prior to this. So the technology sector in the United States still bodes a pretty high price to earnings ratio. The AI theme has been legitimate in some ways, but also the valuations there are still stretched. So what we're also seeing, though, is estimates for earnings growth look aggressive. We're looking at maybe 20 to 30% earnings growth estimates out of tech again into 2026. We think that might be too high. And so what we're trying to do is find places where earnings are more dependable, earnings are more realistic. Again, things like utilities, things like industrials, look a bit better to us, a bit cheaper, but strong earnings growth nonetheless.
And are you looking small cap, medium, anything like that?
Yeah, we are down in mid cap. Mid cap is often undercovered or underloved because people either go large or small. Mid cap is actually the sweet spot to us. So in large cap, it's more expensive. In small cap, it's lower quality. But in mid cap, you get really the best of both worlds. It's relatively cheap and it's relatively high quality. The biggest sector in mid-cap is industrials. And again, that's our favorite sector really globally, other than utility-type businesses. Industrials can benefit from the One Big Beautiful Bill. They had strong earnings growth in Q4. They're estimated to have of the best earnings growth in 2026. So better earnings growth, high return on equity businesses, holding on to those kind of companies in times where you can get whipsawed so easily. Focusing on the fundamentals makes a lot of sense to us here.
So you like essentially the mids kind of they have a bit of a track record already, and they've kind of proven themselves.
That's right. And even in small cap, to your point, there used to be so much companies that would go IPO and grow up in the public equity market. Well, nowadays with private equity or private debt or even the bigger tech companies, they're buying these smaller companies before they can IPO. And they're IPOing now as more mid-cap companies. So small caps simply aren't what they used to be. Mid-caps, on the other hand, you are seeing those more established companies. Like you said, they've got boards. They've got a proven track record. And they typically are making money. So that's all good things in our book.
I don't think people would complain about that. You're saying also credit's held up well through all this.
It has, but we are, watching this closely because credit spreads are hugely important to the economy and risk sentiment. And really, if spreads start widening, and what credit spreads mean is kind of a lower quality bonds yield relative to a government bond yield. And if that yield widens or gets incrementally higher and higher, we've got an issue on our hands. Right now, we're sitting at about a 3% spread relative to treasuries, at least for lower quality corporate bonds in the United States. That's not too bad. It's going in the wrong direction. It had been ticking up. But a day like today, it's probably reversing. We're probably back in the twos. 2% spreads have been historically pretty tight. So again, we've got to focus on what we call our canaries in the coal mine. One is high yield spreads. The other is initial jobless claims in the United States. Both are still singing as of now, at least.
And where would you like to see those spreads?
Yeah, so where they are is okay. If it's 2 or 3, low threes, we're okay. If it gets to 4 or 5%, then we've got a big problem on our hands. And, I think it is one of these markets, we're watching the private markets too, because that has been a big development relative to last economic cycle. But high yield on the public space, at least it's liquid, at least it's giving you a real-time indicator, and it's still not signaling anything too significant to the downside. Like I said, at least as of yet.
And you mentioned about unemployment hasn't been the strongest lately. Any concerns about that?
Yeah, the jobs market has been an enigma. It's tough. I mean, one second you're feeling like the jobs market could deteriorate. The February jobs report in the United States wasn't great. The Canadian jobs report wasn't great. But then you look at other things like initial jobless claims in the U.S. where people would file for unemployment benefits. That's still super low at 205,000. We're still seeing the consumer holding in terms of spending as of now. But the trends in the jobs market haven't been good. But what they're doing is they're moving at this glacial pace. It's super slow motion. And as long as that's happening, it's not a super large cause for concern. But if it did break, if you saw initial jobs claims rise, the unemployment rise significantly, that'd be an issue. For now, again, we're holding it.
All right. What are you looking for to say, you know what, this rally actually has some staying power? I mean, it's only Monday, so by the end of this week, we could be in a completely different spot. But when we start looking and going, maybe we've got something to move on here.
Yeah, so at the end of the day, the market's going to be hyper focused on oil prices, and right now, you're seeing this downdraft in oil, but we're going to have to see where we settle. We're going to have to see where we're at the end of the week. We do have some economic data points all over the world this week, so it's called PMIs, so Purchasing Manager Indices. We get it for Eurozone, Japan, U.S. That's going to be important to see how much of a growth shock we're working on here. And then also keep an eye on bond yields. Bond yields have been rising. That's tightening from central banks. In essence, even though it's the markets that are doing it, the central banks didn't lean against it last week. And in our view, if bond yields keep going up like this, that could trim this rally. But if we got some good economic data and bond yields could calm down, oil prices could calm down, it might be more of a durable rally than we think.
All right, we have to leave it there, Matt, but thanks very much for joining us as always.
Thank you.
Matt Miskin, co-chief investment strategist at Manulife John Hancock. Coming up, the S&P 500 shortly, for a little bit, dipped below the 200-day moving average for the first time since May. We'll see whether it means investors should expect more volatility in the markets. That's after the break. The S&P 500 is hovering around its 200-day moving average, even dipping below it at one point, a key long-term support level, and aligned traders watch closely. History shows volatility almost triples when the index falls below it. Let's digest for now what that means for investors with Chris Kane, Bloomberg intelligence analyst. Chris, thanks very much for joining us.
Thank you for having me.
Okay, it briefly dipped below late last week. It was a terrible end of the week last week. We're back above it. How are investors looking at this right now?
Yeah, we'll see. I mean, like you said, we're back above it today. We just crossed below it on Thursday, so it's just been a 2-day trip here below the 200-day moving average. So it'll be very interesting to see if this holds. I think if it was such a short trip below the 200-day moving average, that's a pretty constructive signal for future returns. But the main thing about the 200-day moving average, and you said it, is really the volatility. You have typically much more volatility below the average. The risk is a lot higher, and that's kind of like the most stark difference when you look at the market behavior above and below the 200-day moving average.
And what's a short stay for you? Like, is it a week at around here, 2 weeks, or is it like a few days and then everybody's going, okay, let's get going on this somehow?
I think if it stays under here for less than a week, that's pretty constructive, right? I mean, to me, if the market breaks down below a key support level and then goes right back above it, basically the support couldn't hold. That's pretty bullish. So that's kind of what I'm looking at right now. But what everyone has to remember about the 200-day moving average, like I said, below it is a much more volatile, and volatility goes both ways. You see the worst days, the larger worst days and larger best days when it's below the 200-day moving average compared to above. So don't be surprised if we see some really strong rallies like we see today after going below the 200-day moving average.
And are there sectors that have a more volatile upside during this time and others that have more volatile downside during this time?
We looked at sector performance above and below their own respective 200-day moving averages. We didn't see much of a pattern there. Typically the higher volatility sectors like tech will show even more of a stark volatility difference above and below that key 200-day moving average. But that's really the only pattern that we've really seen. We haven't really seen much of a behavioral difference between sectors when you look at this average.
All right, so along with this increased volatility, are there other ways to measure the uncertainty that comes with being below the 200-day MA?
Like I said, I mean, there's many ways to measure it, right? I mean, to me, it's like the volatility is higher, the uncertainty of outcomes is just higher. So again, you can look at, like, for example, best days and worst days. The best day is plus 11%. The worst day is about minus 11%, below the 200-day moving average. Above the 200-day is about plus 4, minus 4. So that just shows such a higher, range of outcomes. You can even see this in what nerdy quants call the quantile breakdown, which is basically the difference between the 75th percentile of results and the 25th percentile results. That's about triple as wide below the 200-day moving average. So the bottom line is that the range of outcomes is much, much higher when we're in a downtrend.
And now we last saw this last May, which of course was after Tax Freedom Day or tariff, all that, the madness that's settled in everywhere. When else have we seen it like this, and what happened on some of those events?
Yeah, I don't have the numbers right off the top of my head, but it is true that when we break down below the 200-day moving average for a very short time, like I said, and break back above it, which it looks like we're doing today, the market isn't over, that has historically been constructive for returns. Maybe I'll look at that when I go back to my desk. But yeah, like I said, a short term or a short break below the 200-day moving average and a move above is pretty constructive. If we stay under here for a week, 2 weeks, 3 weeks, that's when, trouble and risk start building.
All right, we'll leave it there. Chris, thanks very much for joining us.
Thank you.
Chris Kane from Bloomberg Intelligence. Coming up, we'll get some stock ideas for your portfolio, including Canadian Natural Resources, a crucial player in the Canadian energy space. Canada's natural gas network is crucial as global alliances continue to shift, and companies like CNQ could see a real opening as geopolitics reshape the energy map. For more, we were joined earlier by Barry Schwartz, CIO and Portfolio Manager at Baskin Wealth Management.
I really want to focus on the Canadian oil and gas infrastructure. Look how important it is given what's going on. Only a few months ago, we remember the U.S. Extracted Maduro from Venezuela, said we're going to get the oil. Oil stocks in Canada crashed. Everybody had an opinion and a take in how it's going to be so bad for the Canadian oil sands, and then 5 minutes later, the world changes. So I think you need to focus on that. The world can change very, very quickly, and the narrative can change. For CNQ, I think it's the most important company in Canada, by the way. The most valuable resource in the world is oil. It has significant reserves, decades of reserves. We just don't have the infrastructure to get more of our high-quality oil to safer places. That's going to take time. I hope this speeds up Canada to focus on, oh, my God, we have such an opportunity here. Because look at what's going on with the rest of the world.
I think everybody's hoping that. But is there that concern that we're going to go up, things are going to calm down in the Middle East, and then it's just all going to get forgotten again?
Possibly, but
we love doing that.
Well, if there's no regime change in Iran or if nothing's settled, we could be back doing this dance again in a few years, right? Yeah. How are we to know? What I love about CNQ is I'm not a commodity person whatsoever. Mm-hmm. I'm scared of owning commodities because the prices are speculative. They go up and down like a toilet seat. We started buying Canadian Natural Resources in 2022 when oil was much higher than the $60 level. And I've made a lot of money on CNQ, not because oil prices have worked for me, because the company can grow production per share each and every year and keep its costs low. And the world finally recognizes that with all these significant reserves in a safe country where the potential is huge, that this valuation has to be worth a lot more than what it was trading at, like a pedestrian oil and gas company. Ridiculous. So would I advise anybody to fool around and buy CNQ here today? I don't think the TSX is going to have a very good day, by the way, if gold goes down and oil prices go down. But certainly if there was a material pullback on Canadian Natural Resources over the next few days, we'd be looking to add more. Great business.
Even with that nice little growth we've seen over the last while.
Oh, for sure. I think it's not a cheap stock anymore, but it's certainly not overvalued given the quality of its reserves, its management, its capital allocation skills.
All right. And Apple, things people need. That's your theme.
I mean, I loved the news last week that Tim Cook traveling over to China. It looks like he's mended the fences there. The growth of the iPhone 17 in China, phenomenal rebound. if you're nervous about AI and don't know how it's going to play out, no one really knows. Apple's the best way. If you want to check ChatGPT or Siri or Gemini, you got the phone. It's not spending any money on capital expenditures for AI.
Yeah.
It's not blowing its brains out. Its balance sheet is perfect. It has tons of cash, and iPhone sale demand is huge. And all these apps that we're going to create with AI, they're all going to be on the Apple iStore. This is the best way, in our opinion, to play AI for the long term.
Not a concern, though, that they're not in the AI race and that they could be left behind?
They are in the AI race. You can't. Apple is AI. You can't use AI without having an Apple product, more or less, right?
But what if there's something?
Gateway.
What if AI builds something to replace it? I mean, there's always that possibility.
Well, yeah. I mean, there's always lots of possibilities. For now, this is the best device. People are completely addicted to it. We keep seeing ads everywhere telling people to put down their phones now because it's become a pandemic of insanity looking at your phones. But I love owning products where people are completely addicted to, so I'm going to stick with Apple.
Yeah, and people are loving the new one. Sales are doing well last time we checked. Is worried that this could be a one-off because they've been struggling for a little while trying to find themselves. They seem to have found it with this one.
The success of the iPhone 17.
Yeah.
No, I mean, if you listen to what Tim Cook is saying, brand new suite of products. The Mac sales are doing incredible. People have to buy. They came up with this cheaper Mac that competes against kind of these Google Chromebooks. That could be a huge win for them. Coming out with, and then of course the next big thing for Apple is the Siri AI agent. Right, it's going to be your personal assistant doing lots of things for you, making doctor's appointments. Who knows what it's going to do for you? But once that is integrated into Siri, into the Apple iPhone, I think it's going to be a must-have product, and it's going to spur huge demand for sales, in our opinion.
And any competitors threatening it right now?
There doesn't seem to be one competitor that has the type of products that Apple has. No question, there's some high-quality producers in China, but Apple's a dominant player across the board. And with its open-end, closed-end system, it's a phenomenal company.
That was Barry Schwartz, CIO and portfolio manager at Baskin Wealth Management. An Air Canada Express plane with 76 people aboard collided with a fire truck shortly after landing at New York's LaGuardia Airport late Sunday, killing the two pilots. We get more now from Bloomberg's aviation and transport reporter Danny Lee.
Let me just walk you a little bit of what happened. So on Sunday night, late Sunday night, a fire truck was being given the authorization to go across the runway at New York's LaGuardia Airport, but it at the same time met an Air Canada Express regional jet operated by Jazz Aviation, and the plane collided with the aircraft, which had tragic consequences. We now know that at least the two pilots operating the aircraft, have tragically died. We don't yet have a handle on just how many passengers on board were injured. So that's 72 passengers on board and 4 crew operating the plane. But yeah, this is a tragic accident. And at a time when US aviation is under such great strain, and particularly on Sunday night, where there were air traffic control were dealing with a couple of emergencies during the night. So this had a cascading level of consequences. And what we see is yet another tragic accident.
Do we know what the other emergencies were that they were dealing with? I mean, it's incredible the idea that there was already 2 going on.
Yeah, well, basically the other emergency all really revolved around another aircraft, which you could hear on air traffic control that air traffic controllers were responding to. And actually, in fact, it's potentially why this fire truck was responding to another emergency. But of course, when you look at some of the horrific images and video that has been circulating on social media, such is the damage to the front of the cockpit, which has basically disintegrated, and the first couple of windows as a result, where the galley would be, and obviously at least one of the cabin crew. So you could see the kind of forceful impact that this aircraft took late on Sunday night, especially during a time there was some bad weather around.
All right, and now LaGuardia, a busy airport. What's the impact on just the operations and beyond?
Yeah, LaGuardia being one of not just New York's, but one of the country's busiest airport for domestic travel, it has at least been closed up until 2 p.m. Eastern. So that it actually involves around 500 flights so far on Monday being disrupted, cancelled in the main. But yeah, at a time when the U.S. Aviation system is under strain, particularly around funding for airport security staff, the huge queues we have seen, and then the broader emphasis from officials to try and modernize the aviation system, the infrastructure, and to make it safer. There are a lot of questions for officials on this accident, and particularly as there will be an investigation getting underway to try and identify the causes of what happened in this latest fatal crash.
That was Bloomberg's aviation and transport reporter, Danny Lee. Well, Know Your Options is back. Tune in Wednesday at 3 p.m. Eastern to have all of your trading options trading questions, I should say, answered by Chris Tom of Moat Financial. Send us your questions at knowyouroptions@bnnbloomberg.ca. Market Call is coming up next. Joining us today on Market Call, Jeff Parent, Senior Portfolio Manager at Castlemore. His focus, technical analysis. And a final look at the markets before we wrap things up. Let's take a look at where the TSX is right now. And it's calmed down a little. It's up near 2% at one point. So still up 1.45% on the news from President Trump that there's been a pause. And they are meeting and talking with Iranian officials, although Iranian news is saying, no, that's not happening. Let's take a look on the TSX and see which sectors, which indices are doing well. And you can see the infotech and materials. They are up nicely, although they've calmed down a little. And energy, not surprisingly, is going the other way. And that is it for Morning Markets. Thanks very much for watching. We'll see you back here tomorrow.